last video in this series, I'm going to go ahead and talk about the efficient markets hypothesis. And this is again something that touches on the 2013 Nobel Prize. And the efficient markets hypothesis is a little bit different than what we talk about in a microeconomic context, where we talked about maximizing total surplus and that kind of stuff. Here we're really talking about are markets informationally efficient? And a market is informationally efficient if it quickly incorporates the available information. And we might, and in fact we do, split this question into three different versions of it. There's what we might call weak informational efficiency. And weak informational efficiency assumes that the information which is included is the asset's own price. So, if weak informational efficiency does not hold, then just knowing the past price of the asset, did it go down in price yesterday or did it go up in price today or what, would allow us to predict what's going to happen in the near future. And this is again one of these things that it is pretty much rock solid, absolutely true that markets at least pass this level of informational efficiency. Then there is the kind of strangely named semi-strong informational efficiency. And the market is semi-strong or semi-strong in its informational efficiency if all publicly available information is quickly incorporated into the asset's price. So, if Steve Jobs dies, then within a matter of minutes or hours or something, that information is incorporated into Apple's stock price. Strong informational efficiency would mean that even information that's not publicly available would be incorporated into the asset's price. And this would typically be because, well, some set of people has access to that information, and even if they're not spreading it all around town, they're going to buy and sell the stock based upon that information, and that's going to cause the stock's price to adjust. So, now, again, we're pretty sure that markets are at least weakly informationally efficient. And then things get a little bit trickier. My own personal reading of the evidence is that it's sort of maybe 70% semi-strong, 10% strong, and then 20%. Is that right? Yeah, 20% weak. So, in particular, we know that sometimes bubbles do happen, and if bubbles are happening, that's consistent with weak informational efficiency, but it's not consistent with semi-strong informational efficiency. We also know that sometimes, even though information is not publicly available, it starts to become incorporated into a stock price. So an example like that might be that, well, let's suppose a company is going to announce its earnings on some particular day, and we're going to watch what happens with its stock price. And suppose it turns out that this company is going to announce that it has a negative earnings surprise, that earnings are going to be lower than everyone anticipated. And we might notice that it's cruising along here, and then actually it starts to drop a couple of days, the stock price starts to drop a couple of days before the official announcement, because someone out there leaked the information, and someone's basically been engaging in insider trading. So, sometimes we do have this strong form of informational efficiency. The tricky thing is, you never know with any kind of certainty whether the asset price you're observing at any particular time is because the market is just being weakly efficient, is it being semi-strong efficient, or is it being strong efficient? My own gut feeling, again, is that most of the time, most publicly available information has been incorporated into the stock price, and so most of the time, asset prices are reasonably close to a consensus estimate of what the asset is worth, given the information that's publicly available out there. And you sort of look at it, and it kind of can't be true that the market could be either 100% efficient or 100% inefficient. If it were 100% informationally inefficient, and asset prices bore no relation at all to economic fundamentals, then any idiot could go out there, gather a little bit of information, and make huge amounts of profits. But in doing so, they would drive asset prices back to their fundamental values. So 0% informational efficiency sort of just can't be true. It also can't be true that the market is 100% informationally efficient, because if the market were 100% informationally efficient, then asset prices would always correspond to fundamental values, and no one would be able to make any money looking up information to figure out what an asset's price is, in which case no one would actually do all that research and all that trading to make asset prices converge to fundamental values, in which case a 100% efficiency could no longer be true. So it kind of has to be somewhere in between these things as a matter of sort of pure logic.